Picture this. You wake up, you check your phone, and there it is. A headline that stops you mid-scroll. Saudi Arabia moves closer to BRICS. Gold hits a record high. Oil spikes past $100 a barrel. And somewhere in the middle of all of it, financial analysts are asking the same nervous question they've been asking for 3 years now. Is the US dollar finally in trouble? This isn't a hypothetical anymore. This is happening right now in 2026 in real time, while most people are still thinking about the price of eggs and gas. So let's slow down and actually walk through what's going on, because the real story is far stranger, far more layered, and honestly, far more interesting than any single scary headline can capture. For more than 50 years, the US dollar has sat at the center of the global economy like the sun at the center of a solar system, with everything else orbiting around it. That didn't happen by accident. Back in 1974, in the aftermath of the US abandoning the gold standard, Washington struck a quiet but historic deal with Saudi Arabia. The Saudis would price their oil exclusively in US dollars, and in exchange, the United States would provide military protection and security guarantees to the kingdom. Over the following years, the rest of OPEC fell in line, and just like that, the petrodollar system was born. Every country on Earth that needed oil, which is to say every country on Earth, suddenly needed US dollars too. That created a kind of built-in global demand for the dollar that no other currency could match. Oil exporting nations collected enormous piles of dollars from selling their crude, more than their domestic economies could realistically absorb. So they recycled those dollars right back into the US financial system, buying treasury bonds, US stocks, and real estate. That recycling process kept American borrowing costs artificially low for decades. It let the United States run enormous trade deficits without the kind of currency collapse you'd expect from any other country doing the same thing. Economists have a name for this. They call it the exorbitant privilege, and it is, without exaggeration, one of the most powerful economic advantages any nation has ever held in modern history. But privileges like that don't last forever unless they're actively defended, and cracks have been forming in this system for a while now, cracks that most people never noticed until very recently. The real turning point, the moment historians will probably point back to, was 2022, when the United States and its allies froze more than $300 billion in Russian central bank reserves in response to the invasion of Ukraine. To really understand why any of this matters, it helps to remember that the dollar wasn't always the automatic, unquestioned king of global finance either. Before World War II, that role belonged to the British pound sterling, backed by the reach of the British Empire and the dominance of the Bank of England. But 2 world wars, the collapse of colonial trade networks, and the sheer economic exhaustion of post-war Britain slowly drained the pound's global authority, and the dollar stepped into the vacuum, formalized through the 1944 Bretton Woods Agreement, where 44 nations agreed the dollar would be the anchor currency of the post-war economic order, pegged to gold with every other currency pegged to the dollar. That system held until 1971, when President Nixon severed the dollar's direct link to gold entirely, an event historians now call the Nixon shock, which is exactly the vacuum the 1974 Saudi deal was designed to fill, giving the newly unanchored dollar a fresh and arguably even stronger source of global demand, this time backed not by gold in a vault, but by the world's thirst for oil. The lesson from the pound's slow fall from grace is that currency dominance rarely ends with a single dramatic event. It erodes gradually, decade by decade, as trust shifts and alternatives slowly mature. And that historical pattern is exactly why serious economists keep telling people to watch the multi-decade trend line rather than any single scary week in the headlines. That single move sent a signal to every government on the planet holding large dollar reserves. And the signal was simple and chilling. Your money isn't fully yours if Washington decides it doesn't like what you're doing. It doesn't matter whether you agree with the sanctions or not. The geopolitical lesson landed hard in finance ministries from Riyadh to Beijing to New Delhi. If your reserves can be frozen overnight over a political dispute, then maybe you shouldn't keep all your eggs in one basket. And that fear, more than any ideology, is the real engine driving the de-dollarization conversation today. Now let's talk about Saudi Arabia specifically, because this is where the story gets genuinely confusing, and honestly, a lot of channels online are getting it wrong. Saudi Arabia was one of 6 countries invited to join BRICS back at the 2023 Johannesburg summit, alongside Egypt, Ethiopia, Iran, Argentina, and the UAE. Argentina later declined. The other 5, including Saudi Arabia, were supposed to formally join starting January 1st, 2024. Here's where it gets murky. Some sources, some official BRICS-aligned websites, and several news outlets report that Saudi Arabia is already a full member as of 2024 or 2025. But according to Reuters, reporting from as recently as this year, Riyadh has deliberately never formally completed its accession. 2 people familiar with Saudi policy told Reuters the kingdom is intentionally sitting on the fence, appearing on BRICS member lists while never actually signing off on full membership, precisely so it doesn't have to choose sides between Washington and this emerging bloc. That is an incredibly Saudi move if you think about it. Keep every door open, commit to nothing fully, and extract maximum leverage from every relationship at once. Whether or not Riyadh ever formally flips the switch to full membership, the direction of travel is unmistakable. Saudi Arabia has spent the last few years deepening its ties with China in ways that would have seemed unthinkable a decade ago. It joined the mBridge digital currency platform back in 2024, a project built with the Bank for International Settlements and central banks in China, Thailand, Hong Kong, and the UAE, designed specifically to let countries settle cross-border payments without routing through the traditional dollar-based system. Saudi Aramco has taken multi-billion-dollar stakes in Chinese refineries and petrochemical companies. The two countries set up a currency swap arrangement. And according to trade data cited this year, yuan-denominated oil settlement between Saudi Arabia and China has, in some reporting, actually surpassed dollar settlement in parts of their bilateral trade for the first time ever. That is a genuinely significant shift, even if it's happening quietly rather than with some dramatic press conference. This is often called the rise of the petroyuan. The idea that China's currency, the yuan or renminbi, could eventually challenge the dollar's grip on global oil trade, the same way the dollar itself displaced the British pound after World War II. And to be fair, the petroyuan is growing. China launched yuan-denominated crude oil futures back in 2018 through the Shanghai International Energy Exchange, and Chinese demand for oil paid in its own currency has only increased since. Iran, squeezed by sanctions, has been settling essentially all of its oil sales to China in yuan for years, often through what's called a dark fleet of tankers that operate outside normal international shipping registries specifically to dodge sanctions enforcement. Russia's Gazprom Neft has settled its China-bound crude sales in renminbi since 2015. Venezuela and Indonesia have followed similar paths for portions of their trade. There's also a more speculative but widely discussed theory floating around financial circles this year, sometimes called the oil for gold pathway, suggesting that when Saudi Arabia accumulates more yuan from Chinese oil purchases than it actually needs for day-to-day liquidity, it quietly converts that excess yuan into physical gold through structured contract arrangements, effectively using China's currency as a temporary bridge to get to a harder asset it trusts more for the long run, precisely because the yuan itself still isn't fully convertible on open markets. That theory isn't confirmed by any official government statement, and analysts openly debate how large or systematic this practice really is, but it captures something true about the broader mood among oil-exporting nations right now. A growing preference for hard, politically neutral assets like gold over promises, denominated in any single government's currency, dollar or yuan alike. But here's the honest, unglamorous truth that a lot of hype-driven content conveniently skips over. The petroyuan is still tiny. Most credible estimates put it at somewhere around 5% of global oil trade, nowhere close to overtaking the petrodollar. Why? Because the yuan still isn't fully convertible on international markets. China's government tightly controls capital flows in and out of the country, which means foreign holders of yuan can't freely exchange it the way they can dollars, euros, or yen, until Beijing is willing to open up its capital account, and there's no strong sign it wants to do that anytime soon because it would mean giving up a huge amount of domestic economic control. The yuan simply cannot function as a true global reserve currency at scale. So no, the petroyuan isn't about to dethrone the petrodollar next year, or probably even next decade, but it doesn't need to fully dethrone it to matter. It just needs to keep chipping away at the edges, and that chipping away is very much happening. Now let's zoom out from Saudi Arabia specifically, and look at what BRICS as a bloc is actually doing, because this is another area where online headlines wildly oversell what's real. BRICS has now expanded to 11 full members, the original 5, Brazil, Russia, India, China, and South Africa, plus Egypt, Ethiopia, Iran, the UAE, Indonesia, and depending on who you ask, Saudi Arabia. Together, this bloc represents somewhere around 40% of the world's population, and a huge and growing share of global GDP when measured by purchasing power, actually surpassing the G7's share of global output when measured on that basis. That's a serious economic footprint. And the expansion isn't slowing down either. There's now serious discussion about Turkey potentially joining the bloc, which would be a genuinely tectonic shift, since Turkey is currently a NATO member, meaning a founding member of the Western Military Alliance, would simultaneously be sitting inside a bloc explicitly built to counterbalance Western economic dominance, a contradiction that would have seemed almost unthinkable just a few years ago. There are also reports of a proposed BRICS grain exchange, which, if it ever actually materializes, could cover something like 44% of global wheat trade, and ongoing talks about admitting Ethiopia and Indonesia more deeply into the new development bank, the bloc's answer to the World Bank, with a stated target of reaching a $50 billion loan portfolio by 2030. None of these are done deals. Most of them are still in the planning or discussion phase, but together they paint a picture of a bloc that is actively trying to build out real institutional muscle, not just hold summits and issue statements. But here is the single most important fact that most sensational videos completely leave out. There is no BRICS common currency, and there is currently no confirmed timeline for one. India's government has explicitly and repeatedly stated it has no policy to replace the dollar. Brazil, during its presidency of the bloc, publicly shelved the idea of a unified BRICS currency. What BRICS is actually building instead is something much less dramatic sounding, but arguably more consequential in the long run: interoperable payment infrastructure. Think of it less like a rival to the dollar and more like plumbing that lets member countries trade with each other without needing to route transactions through the US dollar and Western banking systems at all. The two flagship projects here are mBridge, the multi-central bank digital currency platform that had processed over 4,000 transactions worth more than $55 billion as of late 2025, and BRICS a decentralized payment messaging system meant to link Russia's SPFS network, China's CIPS system, India's UPI, and Brazil's PIX, essentially stitching together each country's existing domestic payment rails into something that functions across borders without needing SWIFT, the dollar-dominated messaging system that most of the world's international bank transfers currently rely on. India, which now chairs BRICS for 2026, has proposed formally linking central bank digital currencies across the bloc, with a full deployment target tied to the 18th BRICS summit happening in New Delhi in September 2026. There's also been chatter about something called the unit, a theoretical settlement instrument that would be 40% backed by gold and 60% backed by a basket of member country currencies. It was piloted in a limited way in 2025, but as of right now, it has no confirmed timeline for broader rollout, and most serious analysts treat it as more of a proof of concept than an imminent reserve currency. So if someone tells you BRICS is about to launch a gold-backed currency that will crush the dollar next year, that's not an accurate read of where things actually stand. What's real is the plumbing project, the slow, unglamorous, multi-year effort to build parallel payment infrastructure that reduces dependency on the dollar system for day-to-day trade, even while the dollar remains dominant for reserves in major contracts. Now, let's talk about gold, because this is honestly one of the clearest, most measurable signals of the entire de-dollarization story. Central banks around the world have been buying gold at a pace not seen in decades. Since 2022, official institutions have purchased more than 4,000 tons of gold, and in 10 of the last 11 quarters, central bank gold demand has topped 200 tons per quarter, which is an extraordinarily consistent pattern that can't really be explained away as short-term speculation. By the end of 2025, the total value of central bank gold holdings worldwide hit an estimated $5.2 trillion, which, for the first time in decades, actually exceeded the value of foreign-held U.S. Treasury bonds. Poland was the single largest buyer in 2025. Kazakhstan has been what analysts call a conviction buyer, steadily building reserves using its own domestic gold production. Brazil made a dramatic return to gold buying in late 2025, snapping up around 43 tons in a single quarter, in what looks like a coordinated BRICS-aligned strategy to reduce reliance on Western financial infrastructure. China and Russia have both grown their official gold holdings substantially over the past decade, though many analysts suspect China's actual holdings may be even larger than what it officially discloses. And then 2026 happened, and gold went absolutely vertical. In February 2026, a war broke out involving Iran, and things escalated fast. Iran began large-scale naval maneuvers in the Strait of Hormuz, a choke point that carries roughly 20% of the entire world's oil supply. The United States rushed carrier strike groups into the region. Gold prices, which had already been climbing, shattered records, spiking to over $5,000 an ounce, at one point touching close to $5,400, an absolutely unprecedented level. Oil did something similar, with Brent crude surging from around $70 a barrel before the conflict to well over $100, and some forecasts warning it could hit $200 if the Strait of Hormuz closure dragged on. Here's the part that should really get your attention if you care about the dollar's status, because normally, in a geopolitical crisis like this, you'd expect investors to rush into U.S. Treasury bonds as the ultimate safe haven, the classic flight to safety trade that's happened during every major crisis for the last 80 years. But that's not quite what happened this time. 10-year Treasury yields actually rose during the crisis, climbing to their highest level in over 18 months, instead of falling the way you'd expect if investors were piling in for safety. Some analysts read that as a subtle but important crack, a sign that the automatic assumption of dollar-denominated treasuries as the world's default safe haven asset is no longer quite as automatic as it used to be. Gold, meanwhile, behaved in its own unusual way too, initially dropping around 10% even as the war intensified, because in the early phase of an energy crisis, the immediate spike in inflation expectations actually strengthens the dollar first, since countries need dollars to pay for suddenly more expensive oil. But that dollar strength faded, and Goldman Sachs has projected gold could reach somewhere between $5,400 and $6,300 an ounce by the end of 2026, driven by a combination of continued central bank buying and expectations that the Federal Reserve will eventually cut interest rates again. Around 70% of central banks surveyed by Goldman Sachs expect their institutions to keep increasing gold reserves over the next 12 months. That is not a fringe trend anymore. That is now mainstream central banking behavior. Now let's talk about the dollar's actual measured share of global reserves, because this is where a lot of the doom and gloom content gets ahead of the data. According to the IMF's own COFR data, the gold standard tracker of currency composition and global reserves, the dollar's share was around 57% in the first quarter of 2026, and it actually ticked up slightly from the previous quarter, from 56.4% to 57.1%. That increase was driven mostly by the dollar's mild appreciation against other major currencies during that period, not by central banks actively choosing to buy more dollar assets. The euro sits at around 20%, the yen around 5%, and the Chinese yuan, despite all the petroyuan headlines, still sits at less than 2% of global reserves, barely moving in years. So here's the honest, nuanced picture. The dollar's share of reserves has fallen significantly over a longer horizon, from around 72% back in 2001 down to the high 50s today. That is a real, structural, multi-decade decline. But in the short term, quarter to quarter, the picture is much noisier and much less dramatic than headlines suggest, with the dollar actually holding steady, or even ticking up in some recent quarters. This is the trap so much online content falls into, cherry-picking a scary quarter or a scary headline while ignoring the fact that de-dollarization, to the extent it's real, is an extremely slow-moving multi-decade tide, not a sudden overnight collapse. Now, why does any of this matter for regular people? Why should you actually care whether some central bank in Riyadh or Brasilia shifts a few percentage points of its reserves around? It matters because of what's happening on the other side of the ledger, inside the United States itself. The U.S. national debt has now crossed nearly $40 trillion. Interest payments alone on that debt are projected to hit roughly $1 trillion in fiscal year 2026, a genuinely historic milestone. And those interest costs are now the second largest category of federal spending, behind only Social Security and ahead of the entire defense budget. The weighted average interest rate the government pays across all its debt has climbed to around 3.4%, up from roughly 1.5% back in 2021. And it's expected to keep drifting higher as older, cheaper debt matures and gets refinanced at today's much higher rates. Over the next decade, the Congressional Budget Office projects the U.S. will pay a jaw-dropping $16.2 trillion in net interest costs alone, if foreign demand for U.S. Treasuries weakens even modestly, whether because of de-dollarization, sanctions-related caution, or simply countries diversifying their portfolios. The government has to offer higher yields to attract enough buyers, and that pushes borrowing costs even higher across the entire economy, touching everything from mortgage rates to auto loans to small business credit lines. This is the actual mechanism by which a slow shift away from the dollar could eventually hit your wallet, not through some dramatic single event, but through a gradual compounding rise in the cost of borrowing money for the government and for you. And the Federal Reserve is caught in its own uncomfortable bind here too. At its most recent meeting in mid-2026, it held its benchmark rate steady in a range of roughly 3.5% to 3.75%, but struck a noticeably more hawkish tone than markets expected, leaving the door open to actually raising rates further later in the year rather than cutting them, largely because the inflationary pressure coming out of the Iran war and the spike in oil prices has made the Fed's job of balancing growth against inflation significantly harder. Higher for longer interest rates might help defend the dollar's appeal to yield-seeking investors in the short run, but they also directly worsen the government's own interest bill on its mountain of existing debt, a genuinely awkward feedback loop where the very tool used to protect the currency's strength simultaneously makes the underlying fiscal picture look worse. Now let's bring Donald Trump into this picture, because his response to all of this has been loud, blunt, and completely central to the political dimension of the story. Since returning to office, Trump has repeatedly and explicitly threatened BRICS nations with massive tariffs, at various points floating numbers as high as 100%, specifically targeting any country that moves to create or endorse a currency meant to replace the dollar. In one particularly memorable post, he wrote that the idea of BRICS countries trying to move away from the dollar while the U.S. stands by and watches is, in his words, over. More recently, he's also floated an additional 10% tariff on any country he views as aligning with what he calls the anti-American policies of BRICS. This puts countries like Saudi Arabia in an extremely delicate position, trying to hedge their economic bets by deepening ties with China and the broader BRICS ecosystem, while simultaneously trying not to provoke direct economic retaliation from Washington, their long-standing security guarantor and, still, their most important strategic partner in many respects. It's a genuinely difficult balancing act, and it's a big part of why Saudi Arabia has been so cautious and ambiguous about its actual BRICS membership status, formally straddling the fence rather than picking a clear side. So where does all of this actually leave us? Is the dollar doomed? Is the whole system about to collapse next year? No, and anyone telling you that with total confidence is selling you something, whether that's fear, clicks, or a gold coin subscription. The dollar remains by far the world's dominant reserve currency, the dominant currency for global trade invoicing, and the dominant currency in foreign exchange transactions, still involved in something like 88% of all currency trades worldwide according to the most recent data. The depth and liquidity of U.S. financial markets, the size and openness of the Treasury market, and the strength of American legal and institutional protections for investors are advantages that simply cannot be replicated overnight by any rival currency. Not the yuan, not a BRICS basket currency, not gold. Building genuine trust in a currency, the kind of trust that makes central banks and global corporations willing to hold trillions of dollars of it, takes decades, not headlines. But it would also be a mistake to dismiss what's happening as nothing. The direction of travel is real, and it is measurable. Central banks buying record amounts of gold, a growing web of alternative payment infrastructure being quietly built brick by brick through projects like mBridge and BRICS Pay, a slow but steady rise in local currency trade settlement between major economies, and a geopolitical environment sharpened by the war in Ukraine, the sanctions that followed, and now the war involving Iran, that has made countries around the world far more nervous about being fully exposed to a financial system that one government can, in a crisis, effectively switch off for them. What we're likely watching is not the death of the dollar, but the slow, uneven birth of a more multipolar financial world, one where the dollar remains the single most important currency for a long time to come, but where it no longer sits completely alone at the center of everything, sharing more and more space with gold, with the yuan in specific corridors like Chinese oil imports, and with new payment systems that let countries trade with each other without needing Washington's financial plumbing at all. Keep your eyes on a few very specific, very concrete things over the coming months, whether Saudi Arabia ever formally completes its BRICS succession or continues to sit deliberately on the fence, whether BRICS Pay actually launches in some functional form at the New Delhi summit in September 2026, or slips yet again, whether gold keeps climbing toward the $5,000 to $6,000 range that Goldman Sachs and others are now forecasting, and whether the next IMF COFR report shows the dollar's reserve share continuing to hold steady or resuming its longer-term decline. Those data points, not dramatic headlines, are the real scoreboard here. It's also worth asking, honestly, who actually benefits if this multipolar shift keeps accelerating? Emerging economies get more flexibility, less exposure to a financial system where one government's foreign policy decisions can freeze their money overnight, and cheaper access to trade with major partners like China without needing to first convert everything into and out of dollars, paying fees and absorbing exchange rate risk along the way twice instead of once. The United States, meanwhile, faces the uncomfortable prospect of a world where it can no longer borrow quite as cheaply as it has for the last 50 years, where its sanctions lose some of their bite because more of the global economy has quietly built workarounds, and where its currency, while still dominant, has to share more of the stage than it's used to. None of that happens overnight, and none of it means the dollar collapses or that Americans wake up one day unable to buy anything with it. Currency transitions in modern history have consistently taken decades to fully play out, not months. And the sheer scale of existing dollar-denominated debt, contracts, and reserves around the world creates enormous inertia that slows any transition down even further, almost like a massive ship that takes miles to turn even after the wheel has been cranked hard in a new direction. So if you're an investor, a business owner, or just someone trying to make sense of your own financial future, the smart move isn't panic and it isn't dismissal either. It's paying attention to the trend line over quarters and years rather than reacting to any single dramatic headline. Keeping an eye on that steady central bank gold buying, watching how the yuan's tiny but slowly growing reserve share moves over time, tracking whether BRICS Pay and mBridge actually scale up into real infrastructure or quietly stall out the way so many ambitious international projects before them have, and watching how Washington itself responds, whether through tariffs, through diplomacy, or eventually through serious fiscal reform aimed at getting that debt trajectory under control before the market forces the issue instead. The competition over the future of global money is absolutely real. It has been building quietly for years, and it accelerated hard in 2026 thanks to the Iran war, record gold prices, and America's own ballooning debt burden. But competitions take time to play out, And this one, the one for the soul of the global financial system, is still in its early innings, no matter how many breaking news alerts try to convince you otherwise. The story isn't over, it's barely getting started, and whether you're watching from Wall Street, from Riyadh, from Beijing, or just from your couch scrolling through headlines late at night, the next few years are going to be worth paying very close attention to.